Hey, welcome back to Academic Market Insights. I'm Dr. Russell Rhodes. That's actually, she's on that side with me, Dr. Larissa Adamiec. Today, we're going to talk about Garch models, and I think we've got so much to say about them that this might be part one of two. Before we get going, hit the thumbs up if you find something that was helpful, etc. Hit the like, feel free to subscribe. And as always, constructive comments are greatly appreciated. We know we're chatty. You don't have to tell us that. Anything with respect to the Garch model, anything maybe we could have done slightly differently, etc. We are wide open for it. There are a couple of, I've got a backlog on suggestions on videos to put together. So in the next couple of weeks, we'll have a couple that were directly from questions from you guys, because now we're on summer break. We have all kinds of time to make videos and write papers and do all the stuff that academics do during the summer. So with that, I'm handing things over to Dr. A, and I will chime in periodically. This was definitely your topic.
Well, and this is, I would make the argument that it's both of our topics. It's hard not to get enthusiastic about volatility if you are in the financial markets, because volatility is what makes you money. And I know you're not supposed to say that, but it's true, right? It's what drives prices. It's without that fluctuation, that price movement, nobody's making any money. So having said that, let's talk about how you calculate this. And we will be talking about Garch model, and we're going to break this into two videos. Garch is a predictive model. And we were talking before how important it is to understand historical volatility. And our textbook has a very specific formulaic way of calculating volatility that sometimes we don't necessarily agree with. And one of the things we wanted to discuss is being able to be flexible, understanding the underlying asset that you're looking at. And for example, one of the reasons why I'm bringing this up is we did a case study this past year where we looked at Simon Property Group. And traditionally, you're supposed to look at 5 years worth of data. And if you look at the 5 years worth of data for a company like that, it really skewed the values. So we truncated that and only looked at 3 years worth of data. Why? Because we felt that was much more reflective of the current environment as opposed to what happened closer to 5 years ago. We're now far enough away from the pandemic that perhaps some of that information shouldn't be applied to our volatility model. Okay. So let's go ahead and take a look. And we have data for several different companies, and we're looking at both monthly and daily data. The textbook that we use quite a bit says to look at monthly data. And they say this specifically so that the data is more smoothed. And at least my background, we're always looking at daily data. I would never think of looking at monthly data. So when I came across this, I was quite struck by it. So let's talk about how to go ahead and build out some of those models. And we're going to build out, let's add some columns in here. Oh, I did it the wrong way, but that's okay.
We need Control Z always.
Yeah. Or we're going to do a Control X. There we go. And we're going to do Control X here. There we go. So these are our daily datas. And this is just nitpicky, but I wanted to kind of give you an idea of what I would do if I was building out a volatility model. And the reason why I'm doing this is for some of my students who will watch this, I'm sure, at some point in the future. So this is daily price data, and I'm going to say raw. Why is it raw? It's because it's untouched data. And it might be the accountant in me, but I like to have the source of data that doesn't get changed so that if you ever want to go backwards and say, what did I do? You have it for you. So the first thing we're going to have to do is take a look. See if I did not calculate this correctly. I need a couple more columns. So what I need to do first is calculate our returns. Okay. So we are looking at the SPY, McDonald's, IBM, Lilly, Cummins, FedEx, Apple, Nvidia. How do you say that?
NVIDIA.
Thank you, thank
NVIDIA.
you.
Yeah.
And I'm completely drawing a blank on Oxy.
You know. Oh, no.
I
I
know.
thought you were playing around about Costco. No, Occidental Petroleum.
That's right. I know
Yeah.
Costco. So
Yeah.
Costco,
You know
for those,
Costco and Costco knows you.
they do. They absolutely do. And Coca-Cola. Yes, I cannot say enough good things about Costco. It's one of my favorite examples to use. So let's go ahead and calculate returns. So we are going to take today's price, subtract it from yesterday's price, and divide it by yesterday's price. So this is a discrete return, and discrete just means that it's countable. We could have used a continuous return, which would have been the log normal of today's price over yesterday's price. Academics like log normal returns because we can then take the derivative of it much more easily. But in reality, everything is countable when you think about the financial markets. So we will go ahead, and it says 0, but that's just because I made this smaller. So let's go ahead and take this out, and I'll go ahead and make those bigger so that we can see the values. And again, these are those daily returns. So we're going to do a quick calculation of the standard deviation. Okay. And I want to make the comment, there's lots of different choices here. So standard deviation P is for population, S is for sample. We have over 1,000 data points, so we far exceed law of large numbers. So we would be actually very comfortable using population. This would still theoretically be a sample because it is not the complete history of all price movements for each of these data series. It will be very, very different, or small differences. All right, let's go. Okay. And then we're going to go ahead and drag and drop or fill in this way. Okay. So these are going to be our standard deviations or volatility for our different securities. And this is for daily. And I want us to take a look and compare it to our monthly. And we'll talk a little bit about the difference between some of these because, for example, let's change these to percents. So we have fluctuation. Again, this is daily data. This is not annualized, and we can go ahead and annualize it. But we can already see that McDonald's and the overall S&P 500 are almost identical. Over here, substantially a higher volatility. So we can see this with the individual securities. If we wanted to, we could even look a little more granularly to try to take a time series, a map, and look at the volatility as it changes over time to see where that comes from. So let's go ahead and pop this up and let's put in monthly price data raw. Copy and paste this over. We're going to go ahead and calculate discrete returns again. And again, this becomes, wrong cell. This becomes today's price minus yesterday's price divided by today's price. And we're looking at monthly data. And what we can see is now we have a lot more information, and these are all the divided by 0 because we don't have that data. So we only have we have less than 60 data points versus those over 1,000 data points for our daily. So we have substantially less information that goes into our monthly calculations. So we're going to call these monthly returns. And let's pop this up. Monthly returns. Let's go ahead and calculate our standard deviation for each of these time series. Okay. And what I think we should do, and you tell me if you agree with this, let's compare them. So we're going to compare them over here so it'll be easier. We'll do paste special, transpose. Let's go ahead and I'll make this into a standard percent. Okay, so let's grab these. And then I think we're going to have to annualize both sets of data. What do you think?
Yeah, I think that for apples to apples, we definitely have to do that.
So let's go ahead and copy and paste. First, I'm going to paste special values. And I'm going to copy, paste special, transpose. Okay. I'm going to come down here. And I'm going to call this daily. Let's call this monthly. Very, very scientific like. But again, this is the only way we're really going to be able to make any kind of comments on what we're looking at. So we want values and then transpose. Oh, paste special. Transpose. So let's go ahead and redo this or put daily and monthly here. Now we're going to take our daily, we're going to multiply it by the square root, right? 252.
For daily, yeah.
Yep. And for monthly, we're going to take take our monthly data, sorry, multiply it by the square root of 12.
You need to, I think you need to use 365.
Okay.
And typically while you do it, I'll talk about it. So 252 is the number of trading days in a year, but because we're comparing something to monthly, I just feel like we should use calendar days instead of trading days. And I'm a big proponent of using trading days over calendar days on a pretty consistent basis. But for this, I think maybe you should go the other direction.
And again, just you even saying that demonstrates how much there really is like an art to calculating volatility, right? Because if we're really thinking about what we're trying to do is we're trying to understand the volatility here, and we've came up with daily and monthly. It's the same time period. Okay, so we haven't changed time periods. So we're not looking at different time periods, but we're looking at how the finite or the frequency, pardon me, the frequency daily versus monthly. We're then changed within daily to annualize it from using 252 trading days to the number of days in the year. So again, we've essentially shown you 3 different ways to calculate volatility for the same security for the same time period. Okay, so I just want to make that very clear. Calculating volatility is an art. So when we look at this, let's pick apart the SPX first. We're looking at 21.3% versus a monthly volatility of 15.83%. So we can see a substantial discrepancy between the two. And just for kicks and giggles, let's see what the percent difference is to see how much of a change it is. Ooh. Let's go. It is in percent. Okay. So we have in the SPX, which is on the lower end of our volatility for our daily, but we see a almost 35% increase from monthly to daily. It's just substantial.
Diversification.
Right.
That, no,
Well,
that really, I truly, that I think that's what you're seeing, is you're seeing the impact of diversification over that longer time period for the
right.
monthly. Yeah.
And interesting, Coke
Oh,
actually,
ring.
yeah, weirdly boring, right? So, Dr.
Yeah.
Bro, I'm going to put you on the spot. Do we expect that a Coca-Cola is going to be able to drive excess returns in the options markets then?
It depends on what they price the options at.
Okay. Unless there's a
And
pricing
yeah,
anomaly.
but if you were an option trader, or a short-term trader, you would
Hmm.
definitely be much more, you would gravitate a lot more toward, and people do, NVIDIA, FedEx, even FedEx. Notice FedEx has a whole lot of volatility because they don't communicate with the street at all, which makes it a pretty interesting stock to trade around with. But I mean, if you look at the top option volume each day in individual stocks, it's almost always Apple and NVIDIA.
Let me see
I
what's
mean, I say almost always. If there's if Google or somebody like that is reporting earnings, then it might be Google that day. But yeah, NVIDIA and Apple, because they have so much day-to-day volatility, traders love them. So you see an awful lot of option trading in those two stocks.
So again, and the reason why we're doing this and focusing on this is so that you can have an understanding of where historical volatility comes from. And again, a lot of finance textbooks really focus on that monthly data and they want a 5-year time period.
Yep.
Again, looking at the same time period at daily, we're going to see more fluctuation because we don't, with the monthly data, we're essentially smoothing that data. And it doesn't give you as much of a sense of the true volatility that you're seeing on a regular part for the movement, price movement. Now, those finance textbooks often also are more interested in super long-term investors. So when you're thinking about this, and we're talking now a time frame of maybe 20 years, as opposed to a time frame of 1 year. So that's something else to keep in mind is when you're thinking about these things, what is the time frame? How quickly are you looking to get in and out of something? Because that's going to help dictate what you should be looking at. And again, when we looked at Simon Property Group, we were looking at a 1-year forecast. So including the pandemic data really didn't make sense because it's a completely different environment than it is right now. And with that, we are going to end our very short discussion on historical volatility. Thank you so much for joining us. If you like this video, please hit like and please subscribe if you haven't. And if you have other thoughts on how to calculate historical volatility, we're very open and willing to hear them, and we can talk about them on the next show. Thank you.
You're really opening it up on the comments, because I know I already know that the 252 versus 365 thing will get some pushback from some traders. But I think for stock returns like this, if we were talking about options, I would say daily. But because we're talking about more of a historical volatility and just taking a look at the annualized daily versus annualized monthly, I think this is a totally fine way to go about doing it. So there, I got the last word. Nah. All right. So with that, come around for part 2.